All right, good afternoon, everyone. Thanks for joining us today. Today, using Value Line's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After the presentation, we have allotted time for questions and answers, so please type your questions into the Q&A box, and I'll get to them at the end. To start, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that is providing investment research for more than 85 years. Our flagship product is the Value Line Investment Service. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including the 1,700 that are included in this service. Value Line does not execute trades for its subscribers, and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. Before I begin the formal presentation, I thought it worthwhile to include an overview of the economic situation, as well as the Value Line Research Department's view of the stock market. The following content was prepared by Harvey Katz, Value Line's chief economist. The good news is coming on several fronts as the third quarter proceeds. First, the Institute for Supply Management reported a jump in manufacturing in June, boosted by a surge in new orders. Then, that trade group issued data showing a pickup in non-manufacturing, led as well by strengthening orders. Thereafter, the Labor Department released its employment figures for June, which contained a positive surprise in job growth for that month, upward revisions for April and May, and a further modest rise in wages. Encouraging, as these trends are, we would not overreact to a few data points. That's because this upturn has been notable for its inconsistency, with a few strong reports, such as we've outlined above, often being followed by lackluster issuances, such as we saw late in the second quarter. All the while, the expansion continues to proceed in underwhelming fashion. The absence of persisting excesses likely explains the upturn's longevity. We think the months ahead will feature more of the same, that is, additional understated growth with few constants. Overall, that checkered pattern should yield GDP growth of 2.5% or so this half. A modestly better performance is still possible in 2018, but perhaps only if a more business-friendly proposals being advocated by the Trump administration are enacted. The Federal Reserve is unlikely to be moved by the recent strength in manufacturing and employment. Our sense is that the Fed will continue to tighten the monetary reins in regularly spaced intervals over the next 18 to 24 months. The next hurdle likely will be the second quarter earnings season. Such reporting, which is now underway, should make for generally good reading, with many more companies than not continuing their pattern of posting positive earnings surprises. The stock market retains its resilience, with equities extending their gains on good news and often rebounding quickly when the tidings disappoint, whether such as one relate to the economy, global matters, or domestic political events. That sequence suggests decent further staying power by the bulls. In conclusion, we believe the careful addition of quality stocks with strong fundamentals is a worthwhile investment strategy at this time. Now for the core presentation. As you can see, I'm currently at our homepage, www.valueline.com. On this page, you can access free of charge daily market commentaries, as well as general interest articles that are written by our analysts. I'm now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head over to our investor tools, as well as the home pages for our monthly stock selection service. However, I want to start at the dashboard, which is the main landing page for subscribers. As Harvey Katz mentioned in his stock market commentary, we believe the careful addition of quality stocks with strong fundamentals is a worthwhile investment strategy at this time. I personally agree with this approach, especially in this market. As we all know, the current bull rally began in 2009, and we have certainly come a long way. Just for perspective, please recall that the Dow Jones Industrial Average bottomed at 6,626 on March 9, 2009. A little more than 8 years later, the index is north of 21,500, or an increase of around 225%. That level of outstanding growth has certainly been a welcome sight for investors. However, at this time, finding worthwhile investment candidates is certainly more difficult, since many stocks are trading at lofty and likely unsustainable price-to-earnings multiples. Other valuation metrics also show that the market, overall, is quite expensive or at least fully valued. From the Quick Links section, I want to highlight the weekly Value Line Investment Survey Summary and Index. This 40-page PDF provides a massive amount of information on the stocks that we track in the survey. For instance, in the center of the first page is Value Line's current PE data. Value Line's calculation includes a combination of actual and estimated earnings per share, which we feel is a more accurate method of evaluating a specific stock when compared to just using earnings from the past 12 months. At present, the median PE of the Value Line universe is 19.7. For comparison, that figure was just 10.3 at the depths of the financial crisis. 19.7, in our view, is quite expensive. Thus, for this exercise, I'm going to attempt to find a good quality equity that is not overly expensive. Before I move on, I strongly recommend that subscribers each week review the data and information published in the Summary Index. It provides important statistics in regard to how the 1,700 stocks in the survey are valued in the current market. Let's now find some investment candidates. Under the Find Ideas tab, I can quickly get to our stock screen. As mentioned, subscribers have access to more than a dozen preset screens, as well as 50 fields. I'm now going to run a screen in order to find good quality stocks with strong fundamentals. Let's start with the good quality part of the equation. Value Line makes this very easy by utilizing our proprietary safety ranks. The safety rank measures the total risk of the stock and is arranged on a scale from 1 to 5, with 1 being the most stable. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downtrends. So for this, let's focus on stocks that have risk profiles that are better than average. So I easily click on the field, and then select 1 and 2. Value Line Screener includes data on approximately 6,000 stocks. As you can see, just utilizing the safety ranks knocks this number down considerably. Another good quality attribute is earnings growth, both historical as well as estimated. So I only want to focus on stocks that have achieved annual earnings per share growth of at least 12% over the past 5 years. After selecting the field, I can accomplish this in 2 ways. I can utilize the sliding action bar, or simply type 12 into the from box. Then click Filter. To make sure that we are focusing on companies that are expected to grow in the future, I'm going to utilize Value Line's proprietary estimates and projections. All of these figures are created in-house by our research team. On the screener list, I'm going to select projected 3 to 5 year earnings per share growth. This is the expected average annual growth of share earnings calculated by our analysts. Again, I'm going to set the minimum at 12%, which is a healthy rate. Overall, companies that are expected to achieve this level or close to it should be firmly in growth mode. Okay, down to 21 stocks. On the fundamental side of the ledger, return on shareholders' equity is a good barometer. It measures how much profit a company generates compared to the shareholders' contribution. The calculation is pretty straightforward. Net income divided by shareholders' equity. Let's add this to our screen. I'm going to be fairly aggressive here, so I'm going to set the lower bound at 20%. That leaves us with 12 stocks. That is still a bit too many. The payment of regular dividends, in a lot of cases, marries quality with fundamentals, since only profitable companies that have excess capital are able to pay and sustain worthwhile payments. More specifically, focusing on companies that have had the ability to increase their annual payouts at a meaningful rate should be a welcome addition to this screen. So let's select dividend growth 5 years. And we'll set the lower end to 10%. Okay, 7 results, which is a manageable list. Any of these stocks may well fit nicely into an equity portfolio that wants high-quality, fundamentally strong holdings. Before I move on, please note that users can save screens and revisit them later by utilizing this button. If you're like me, you tend to watch a batch of stocks for a few days or weeks before seriously consider taking a position. Value Line's watchlist tool makes this easy. I can access watchlists from the menu above. To save time, I've already created the watchlist for these stocks, but the process is very quick and easy. Simply click on Create Watchlist and follow the steps. A quick glance at the 7 holdings shows that only Lowe's is ranked 1 highest for timeliness. For those that don't know, Value Line's proprietary ranking system for timeliness ranks stocks on a 1 to 5 scale for relative price appreciation for the next 6 to 12 months. Thus, the system believes that of these 7 stocks, Lowe's will be the top performer. As we already know, Lowe's also possesses a number of other favorable investment attributes, and I'm going to take you through a few of those. Let's now click on the company name and get more information. I am now on Lowe's digital stock report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden, so you can create your own customized stock report. For instance, let's say I'm most interested in the analyst commentary. I can simply click and drag the box to the top. In addition, now I want to see more rank-related information. For that, I simply click on the larger rectangle in the heading. Once I alter the presentation, I can save the changes from the sliding horizontal action bar. The next time I come to this stock report, it will look the way I set it up. Now let's get some background information in regard to Lowe's business and prospects. In the most recent analyst commentary, Associate Director of Research, Matthew Spencer, stated, Lowe's fiscal first quarter results were weaker than expected. Comparable store sales rose a scant 1.9%. For comparison, its main rival, Home Depot, notched a 5.5% gain. What's more, a 3.5% increase in the average ticket was partially offset by a 1.5% dip in traffic. Despite a favorable macroeconomic backdrop, management had a few sales missteps, which contributed to the lackluster performance. Specifically, leadership focused on indoor projects, which hurt sales of lawn, garden, seasonal, and other outdoor categories. This mismatch also resulted in more aggressive promotional activity, which weighed on margins. Let's now view Lowe's recent stock price action. From the valuation module, I can quickly pull up a stock chart. And the yellow line is the equity's performance. As you can see, it has declined over the past few months. In fact, since April, the price has dropped more than 7%. For comparison, the S&P 500 index is up 5% over the same period. We think that this notable underperformance has created a good entry point for investors. Moving to the top of our digital report, you can see that Lowe's is currently trading at around $77 per share. That valuation is well below our 3 to 5 year target price range of $100 to $135. This range is an extremely popular value line proprietary metric, and most other research houses do not provide such projections. I now want to show you the classic PDF report, which is included with a digital subscription and provides some analysis of why the stock may well eventually trade at that lofty level. Going back to Matthew Spencer's commentary, we think that the retailer will get back on track in the July quarter and over the balance of fiscal 2017. Efforts to rebalance the indoor-outdoor strategy have already started to bear fruit. Enhancing the media message on value and improving the effectiveness of promotional offerings should also help. And leadership expects to recover the first quarter sales miss over the current and next 3-month interims. As you can see on the left in the quarterly boxes, Value Line expects healthy top and bottom line gains for Lowe's this year and in 2018. What's more, thanks to a likely lower share count, a greater number of stores, and a wider net profit margin, we project that earnings will reach $7 by the 2020-2022 timeframe. All told, our outlook for Lowe's business and stock are quite favorable. We think it would make a fine addition to equity portfolios that prioritize quality and fundamentals. Another useful investor tool that Value Line offers is the Alerts Hub, which can also be accessed via Find Ideas. Users can set up notifications and receive an email or text message when a notable event occurs for a specific stock. You can set up alerts for a variety of events, including when the price of the stock moves considerably, when there is a trading volume spike, or when Value Line changes the rank of a particular stock. In total, more than 15 alert functions are present. Let's quickly set up an alert for Lowe's. For instance, after participating in this webinar, perhaps you want more information before establishing a position. You can set up an alert and get notified when Value Line puts out a new report on this issue. And as you can see, now my alert is set up. I hope you found the method for finding a stock to buy right now interesting, informative, and efficient. I do also want to point out, however, that Value Line offers a variety of model portfolios that can help alleviate the work of finding worthwhile investment candidates altogether. Part of the Value Line Investment Survey is the weekly selection and opinion. Along with economic and stock market commentary are 4 model portfolios. Each one has a different investment strategy, is actively managed, updated each week, and always contains 20 stocks. The portfolios are overseen by senior research analysts. Portfolio 1 is best suited for aggressive investors and focuses on stocks that are expected to outperform the broader market over the year ahead. Portfolio 2 should be of interest to more conservative investors and focuses on dividend-paying stocks that also offer worthwhile appreciation potential. Portfolio 3 chooses equities with long-term price growth potential and, of course, is best suited for patient investors. Portfolio 4 is filled with stocks that possess above-average dividend yields and is for investors seeking current income. We have a great number of subscribers that follow these portfolios. For those interested in possibly adopting one of these strategies, here are a few helpful details. New positions always amount to 5% of the market value of the respective portfolio at the time of the trade. Any dividends received are taken as cash. They are not reinvested. Lastly, the portfolios are not rebalanced. All told, the model portfolios represent some of the Value Line Research Department's best investing ideas, and we recommend that you read the analyst-created content and look over the portfolios for possible additions to your holdings. Subscribers looking for a total investing solution are also encouraged to check out our monthly stock selection services, Value Line Select, Dividend Income and Growth, and Special Situations. If this is something that sounds up your alley, please call 1-800-VALUE-LINE and we'll provide you with a free report. This marks the end of the formal presentation, and I will now take your questions. So give me 1 sec while I look to see what came in. All right, hold on. Sorry, there's quite a bit of coping with audio issues. Okay. First question. When changing the layout of a digital report, will it alter all the stocks or just the one I'm on now? That's a good question. Just to refer back to what we did, you saw that I changed the analyst commentary position on Lowe's digital report and changed the rank stocks. You have to do that for each individual stock. So if you changed it for Lowe's, it wouldn't alter the presentation for Home Depot. Reason being, with all the stocks we cover, there are actually different modules and different setups. For instance, certain modules for a bank is going to be different than the modules for an insurance company or a defense company. So it has to be done individually. Next question. Let me just get there. Does Value Line provide research on ETFs? Yes, we actually have 2 ETF products. The Value Line ETF survey provides data and screening abilities on the entire ETF universe of the U.S. and Japan. In addition, we recently launched a new product called Value Line Select ETFs, where we recommend for purchase a new ETF every month, and then recent recommendations go into a portfolio. And that's created in-house by a senior analyst. Next question, do you plan on covering BHGE? Yes, that is the plan. For those of you that don't know, BHGE is Baker Hughes, a GE company, is what they're calling it. It's a recent merger between General Electric and Baker Hughes. We do plan on adding that in the short term. Okay, next question. Can we build a report inputting ticker symbols of stocks we are interested in following that gives us the current Value Line ratings for each? Yes, so that is the watch list function. You know what, I'll pull that back up. We can look at the stocks we just highlighted. So here's the list. As you can see, here are the Value Line ratings. Obviously, if you want to get to the full reports, all you have to do is click on each individual stock. I hope that answers that question. Let me just scroll through to see if there's anything else. Oh, what was the percentage you used for shareholders' equity? I used 20%, which I mentioned was pretty aggressive, but I didn't want to show you a watch list filled with 100 stocks. Next question, can you have more than one watch list? Yes. users can have, I believe it's at least three watch lists, I believe. Higher end subscriptions can have more, but I believe it's 3. I believe those are all the questions. I want to thank everyone for participating. Thank you very much. Have a great summer and a great day. All right, take care.